Welcome to The Explainer. Today, we're going to demystify the Indian stock market. Look past all that daily noise to really understand the patterns, the cycles of boom and bust, and figure out how to make sense of it all. I mean, we've all seen the headlines, right? Sensex soars to new highs one day, and then the next it's market plummets on global fears. It just feels so chaotic, so totally unpredictable. But what if I told you there's actually a rhythm to it, a predictable pattern hiding behind all that chaos? All right, let's dive right in. Here's our game plan. We're going to start with the basics, what we're calling the market's four seasons. Then we'll get into the exciting stuff, riding the bull, and maybe more importantly, surviving the bear. After that, we'll look at what makes the Indian market tick, and we'll wrap it all up with a strategy you can actually use. Okay, first things first. Before we can even talk about bulls and bears, we have to get our heads around the big idea that drives everything, the market cycle itself. So try not to think of the market as a rocket ship that only goes straight up. It's much more like the seasons. There are periods of growth and then periods of decline. And this whole cycle is powered by two of the most powerful human emotions out there, fear and greed. Plus, of course, what's happening in the broader economy. And here's why that's so important. It puts everything into perspective. While the day-to-day swings feel totally random, they're often just small parts of a much longer, more predictable timeline. What feels like a huge crisis today might just be one phase in a larger pattern that plays out over many, many years. In these cycles, they pretty much always have four distinct phases. It kicks off with accumulation. That's when everything looks bleak, but the really smart investors are quietly starting to buy. That leads to the bull phase, the one we all love, where optimism spreads and prices just keep climbing. At the very top, you hit distribution. This is peak euphoria, and it's when the smart money starts to sell. And, well, that's what leads into the bear phase, where panic takes over, prices fall, and the whole cycle gets ready to start all over again. Okay, now let's zoom in on the part everyone gets excited about, the bull market. This is the season of sunshine, growth, and good vibes. So at the highest level, you can think of these as the two opposite poles of the market. In a bull market, everyone's feeling confident, the economy's humming along, and stock prices are consistently hitting new peaks. A bear market, yeah, it's the exact opposite. Fear is everywhere, the economy is struggling, and the trend for prices is down, down, down. During a bull run in India, it feels like the whole economic engine is firing on all cylinders. The big indices like the Sensex and Nifty are climbing, companies are reporting record profits, money is pouring in from both foreign and domestic investors, and new companies are lining up to go public. It just creates this amazing, powerful, positive feedback loop. And we don't have to look back too far to see a classic example. Think about the period from 2014 to early 2020. You had strong economic growth, big reforms, and the result? The Nifty more than doubled. It was this incredible multi-year run where the fundamentals just kept pushing the market to new heights. But as we all know, no season lasts forever. What goes up? Well, it usually comes down. And that brings us to the most feared part of the cycle, the bear market. Now, this isn't just a little dip or a temporary correction. A 20% drop from the latest peak, that's the official line in the sand. Once an index like the Nifty or Sensex crosses that line, we are technically in a bear market. And in a bear market, that positive feedback loop we just talked about, it completely reverses. Foreign investors start pulling their money out. Retail investors start to panic sell. Company profits shrink. And it seems like every single news headline is negative. It becomes a vicious cycle of fear feeding on itself. The 2008 global financial crisis is just a brutal example of this. The panic that started overseas absolutely hammered India. The Nifty index plunged by a staggering 60% from its peak. It was a really painful reminder of just how severe a bear market can get. Okay, so while global events like the 2008 crisis are obviously huge, India's market cycles are also shaped by a really powerful and unique set of local forces, stuff you just won't find anywhere else. I mean, just look at this list. These are some of India's biggest market movers. It's everything from the success of the monsoon, which literally affects the income of millions of people in rural India, to the uncertainty around a general election. Of course, what the RBI does with interest rates and the flow of investment money are absolutely critical too. Let's just take one of those factors for a second, crude oil. India imports over 80% of its supply. Now, what that means is that whenever global oil prices spike, It hits our economy directly. It affects inflation, the value of the rupee, and company profits. So you can see why it's such a powerful trigger for our market cycles. But here's a really interesting trend that's been developing. Historically, if foreign investors started selling big, our markets would pretty much always follow them down. But lately, the power of domestic investors has been growing and growing. This rise of DIIs is now acting as a powerful counterbalance, kind of like a shock absorber that helps cushion our markets from some of that global volatility. It's a real game changer. Okay, so knowing all this is great, but the real question is, so what? How do you actually use this knowledge? Let's talk strategy and how you can actually navigate these crazy cycles. The good news is you don't have to just guess. You can use some key indicators to get a feel for which season the market is in. You can look at valuations like the Nifty PE ratio, and all that is really is a price tag for the market. It tells you how expensive stocks are relative to their earnings. A really high PE, for example, is often a warning sign that the market is getting overvalued. Look, the right strategy is not about trying to perfectly time the top or the bottom. Honestly, that's pretty much impossible. It's about adjusting your behavior. So in a bull market, keep your systematic investments going, but maybe trim a little bit, take some profits off the table. And in a bear market, the key is not to panic. Instead, you can actually see it as a sale, a big opportunity to buy quality assets at a discount. And if you need any proof that staying consistent works, just look at this number. Despite all the crashes, all the rallies, all the drama, systematic long-term investing in India has historically delivered strong returns, often in that 12 to 15% range. It's powerful proof that time in the market is so much more important than timing the market. And that right there is probably the most important takeaway from this whole conversation. Your ultimate success as an investor isn't going to come from some magical ability to predict the next market move. It's going to come from managing your own emotions and sticking to a disciplined plan, no matter what season the market is in. So as we wrap up, I'll just leave you with this one thought. The market is always going to have its seasons of sun and storm. You can't control the weather. The only thing you can actually control is how you prepare and how you respond.